Record highs in equities are colliding with stubbornly high long-end yields, softer U.S. jobs data, and a world of rolling supply shocks. This uneasy balance is exactly what allocators need to dissect today on vTalkInsight, Allocator's Lens Daily for August 10th, 2026. Let's start with equities, where the earnings and AI story still dominates, but the risks around positioning and policy are getting harder to ignore. In equities, the dominant feature is how strong the tape still looks despite rising macro noise. The S&P 500 has pushed to fresh records, gaining well over 3% on the week, and the Nasdaq has outperformed, underlining robust risk appetite. Implied volatility sits in the mid-teens, so markets are pricing this strength as relatively stable, even as the macro narrative feels anything but comfortable. Under the surface, breadth is healthier than at any point in the last couple of years. Roughly 3/4 of S&P names are trading above their 200-day moving average, and earnings growth is no longer just a mega-cap tech story. 8 of 11 sectors are contributing to profit growth, with financials, industrials, and healthcare now carrying more of the index-level advance. At the same time, AI remains the key upside engine and the main source of fragility. Big tech companies are showing rapid payback on AI capital expenditure, with some reporting sub-3-year returns, and recent results from names like Microsoft have eased doubts about monetizing the cloud and AI stack. But more than 60% of recent index gains are still coming from a narrow group of large platforms. Investor sentiment has reached extreme bullish readings last seen in 2021, and the fear of missing the AI trade appears stronger than fear of drawdowns. Company-level dispersion reinforces how selective this environment has become. Cloudflare and Airbnb have been rewarded for strong earnings and guidance, while Sweetgreen and some quick service peers are being punished for weak traffic, higher prices, and reputational hits. That mix points to an equity market that still pays up for clear growth and AI efficiency stories, but offers little forgiveness where execution or pricing power are in doubt. The main equity risk now sits where this earnings strength meets the rates and macro backdrop. A negative U.S. payrolls print, weaker wage growth, and easing inflation readings have all helped by pulling rate hike odds for September down from above 50% to below 40%, and that triggered rallies in stocks and even gold. But investors are very aware that long-end Treasury yields remain elevated and could move higher if fiscal, issuance, or AI capex pressures intensify, which would test rich equity positioning and the AI trade in particular. Turning to rates, the picture is one of unstable equilibrium between softer data and relentless supply. The latest U.S. labor report showed an unexpected loss of around 23,000 jobs and very weak wage growth, with average hourly earnings rising just 0.1% on the month and about 3.2% year-on-year. That pushed market implied odds of a September Fed hike down sharply, even as several officials keep warning that they need more evidence of disinflation before considering cuts. Despite that dovish shift in probabilities, yields across the curve remain high. The 2-year trades in the low 4s, the 10-year in the mid-4s, and the 30-year above 5%, levels that embed both tight policy and a meaningful term premium. Heavy Treasury issuance, deficits running above 6% of GDP, and a surge in long-duration corporate borrowing linked to AI capex are all pushing the long end higher, while traditional foreign demand has softened. Investors have responded by favoring the short end of the curve, where yields are attractive without the same exposure to long-run fiscal and supply risks. The Treasury itself has leaned toward shorter maturities, and there is talk of emphasizing 5-year notes where demand looks robust. At the margin, dollar liquidity backstops for central banks reduce the risk of forced Treasury selling in a crisis, and strong demand from pensions and insurers is helping to absorb both government and corporate supply at these real yield levels. The risk case is that this fragile balance breaks. A renewed push toward 5% on the 10-year, whether from additional AI-related issuance, concerns about U.S. debt management, or foreign reserve sales linked to FX intervention, could force a sharper reaction from equities and credit. Upcoming CPI, PPI, and subsequent labor prints will be crucial in determining whether the Fed can stay on hold, as some large managers expect, or whether the debate shifts back toward another hike later in the year. Credit sits at the junction of these forces and still looks surprisingly calm. Spreads on BB corporates are tight. Global bank stocks are at record highs, and all-in yields offer high single-digit income without having to move far down in quality or liquidity. Corporate bonds now provide a meaningful cushion over treasuries, which helps absorb some rate and spread volatility. The stress points are clustered around the AI, funding wave, and a handful of weaker sectors. High-grade tech bond issuance has exploded to roughly $200 billion this year from a little over $10 billion, as companies finance data centers and infrastructure. Alphabet's recent $25 billion deal, while heavily subscribed, needed pricing up to about 130 basis points over treasuries and has traded poorly since, and there's an expectation that spreads on even top-tier hyperscalers could widen over the next year. Looking ahead, AI-related capex between January 1st, 2026 and December 31st, 2028 is estimated in the trillions, with around $1.5 trillion likely funded through credit markets. That supply overhang is one reason some see investment-grade tech as less compelling, while high-yield AI names, with potential ratings upgrades, look relatively better placed on a pure technical basis. Beyond technology, European autos and chemicals are flagged as candidates for fallen angel downgrades, and cases like Oracle's move to the brink of junk show how quickly funding costs can jump when balance sheets are stretched. Private credit rounds out the picture without, so far, flashing systemic alarms. Defaults and restructurings are occurring, but they're seen as part of normal market evolution rather than a broad solvency crisis, with credit selection central to avoiding capital loss. At the same time, securitized assets, such as asset-backed securities and parts of commercial real estate, are described as fundamentally sound and offering better relative value than crowded investment-grade corporate segments. In foreign exchange, the yen remains the focal point for cross-asset allocators. Japan has now confirmed multiple interventions around the spring holidays aimed at slowing yen weakness, and there was at least one episode of coordinated action with the United States that surprised European officials by bypassing the usual G7 choreography. Even so, the yen is only modestly stronger, and dollar-yen remains elevated, prompting questions about how effective one-off operations can really be. Upcoming U.S. data still matters greatly for the currency path. Earlier, a stronger-than-expected payrolls number was seen as a risk trigger that could have reignited dollar strength, pressured the yen, and forced more aggressive intervention in thin liquidity conditions. Instead, the weak July report has eased some of that immediate pressure, but policymakers in Tokyo are still watching U.S. yields closely because any renewed spike could both weaken the yen and push them towards selling treasuries to defend the currency. This makes FX a key transmission channel for the broader macro story. Policy divergence between a data-dependent Fed, near a potential peak, and a still very accommodative Bank of Japan keeps dollar-yen volatile and ties the pair directly to U.S. rate expectations. For global allocators, that means currency management and hedging choices intersect directly with views on U.S. duration and the sustainability of current yield levels. Commodities reflect the same mix of resilient flows and persistent fragility. Brent crude is trading just above $80 a barrel even as tensions around the Strait of Hormuz and the Red Sea escalate, with reported Iranian naval actions and more frequent attacks on shipping. Tankers are increasingly rerouting away from the Red Sea, and bunker fuel costs have surged about 60% since February, raising global shipping expenses and reinforcing a geopolitical risk premium in energy. So far, supply has proved more robust than some feared. Gulf producers have used pipelines to the Red Sea and Mediterranean to keep exports flowing, and the United States has eased some domestic constraints, including pipeline expansions and selective waivers, to stabilize internal energy markets. Even with those adaptations, longer routes and disrupted canals mean higher logistics costs, feeding into a new normal of stickier supply chain inflation rather than acute shortages. Industrial metals tell a more structural story. Copper prices are up roughly 50% year-to-date, supported by AI infrastructure, defense spending, renewables, and electric vehicles, while new supply is constrained by very long mine development timelines. On top of that, climate-related disruptions from low water levels on the Rhine that cut shipping capacity to wildfires and drought affecting European industry and nuclear output underline how physical constraints and energy transition demands are increasingly central to the growth and inflation mix. Stepping back across assets, the picture is of an AI and earnings-powered equity market running ahead of a rates and commodity backdrop that looks much less settled. Stocks are at records with broad participation, but positioning and concentration are stretched just as the Fed leans on data dependence. Long end yields digest a wall of fiscal and corporate supply, and credit markets quietly warehouse a wave of AI-related issuance. FX and commodities amplify these tensions, with yen intervention, shipping disruptions, and climate-driven bottlenecks all feeding back into inflation, term premia, and ultimately risk pricing. For allocators in this environment, the key signals to watch are the next rounds of U.S. inflation and labor data, the resilience of demand at the long end of the Treasury and credit curves, and how energy and copper prices respond to ongoing geopolitical shocks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.